I do think we're in a bubble, but I also think it's unlike any other bubble. The great bubbles of history, whether it's the South Sea bubble or 1929 or the tech bubble, you take a very good economic situation and you merely extrapolate it into the future. And if you do that and it actually occurred, the market would be worth very high multiples of book and earnings and so on. It's a very simple game. Believe in today's perfect conditions and assume, unrealistically, as it turns out, that it will go on forever. If you did that today and you extrapolated today's conditions, which are miserable, you would, of course, have the very opposite of a bubble. So that makes it unique. We're in the highest 5% of PEs, and we're in the lowest 5% of economic conditions today. So there's never been anything like that in history. And why has it happened? We know the trouble is, of course, COVID, and we know the push on stock prices is a combination of central banks, the Federal Reserve, and fiscal spending. And it's global. So we have never had such a global agreement that every government is looking to spend and every government is looking for their central bank to accommodate. This is an enormous push. And what we discovered long ago is how effective that is at moving stock prices. It's as if every dollar that is not absorbed by the real world flows through line of least resistance, flows through into asset pricing. That is what is happening. It's a very impressive struggle between the real world of productivity and employment and GDP and the paper world of PE ratios and house prices pushed by easy credit, low interest rates, of course, being key, and just plentiful supplies of money flapping around to those people who are likely to buy houses and stocks. It is not necessarily the case at the small business level at all. So this is not necessarily terrific for the real broad economy, but it is clearly terrific for the stock market. And the question is, does the real world eventually catch up? And since this is novel economy, just like the novel virus, you can't be quite as certain as you could in prior bubbles. I described our confidence in prior bubbles as near certain. All of those things, of course, occurred. And you can't be that certain this time because the forces are unique. That's going to make life more intellectually interesting. However, my bet would be, of course, that reality will catch up with the high PEs. When you buy overpriced assets, you get a guarantee of a low return. What you don't get is the guarantee of being wiped out next week. My belief is that if you're trying to time the breaking of a bubble, the value is not that important. All of them are overpriced. And whether they're overpriced at 25 times earnings or 35 times earnings, or in Japan at 65 times earnings, it's very difficult to work out in any sort of academic way, since you're dealing with craziness, where it's going to peak. I much prefer to look for signs of truly crazy behavior, because every bubble that really crashed and broke in a spectacular way, which most of them did, was preceded by craziness, by legendary stories. This was notably lacking, as I wrote and talked about over the years of the 10-year bull market. It has not been lacking, really, I think you could agree, in this rally off the COVID low. We have seen not only a terrific rate of acceleration in the price rise, double the normal bull market, which is characteristic. That acceleration is characteristic of a late stage bubble. But we've also seen wonderful craziness. The SPACs, which are a promise to use your money, give me your money and trust me, I'll do something useful with it, is a real echo of the South Sea bubble, where we have such a spectacular opportunity, we can't reveal what the purpose of your money is yet. And they got lots of money and ran off with it. I'm not saying the SPACs will run off with your money, but I am saying it's a real testimonial to the speculative nature. Buying Hertz, a bankrupt company, and having it go up 4, 5, 6 times in a real hurry, and so on and so on. You read about your own, having a Tesla quadruple this year. I own a Tesla. It's a wonderful car. I think they're a spectacularly interesting company. But are they 4 times the company they were before COVID? I don't think so. These stories are everywhere, and they're what you need before a bubble breaks. And we saw them in early 2000 and late 99. And we saw them in late 1929 before the crash. We saw them in Japan, and here we are again. So I think this is an indicator, not a certainty, but a strong possibility that we are quite close to the bubble breaking in terms of psychology. Perhaps a matter of weeks or months, not years. And I am sympathetic to the argument, what am I supposed to do? The yields are so low. But the market doesn't care that you don't have easy, safe investments to make. And your desperation is your own matter. What it does is focus on the difference between short-term and long-term. On the short term, you can say, I'm offered nothing by fixed income. I get something out of stocks, even though it's half what it seemed to be in the yield. It's still better than nothing, therefore I'll do it, and the prices rise. And that is a logic that you hear one way or the other all over the place. And then there's the argument in the long term, which is, in the end, all assets equal replacement cost. House prices go up, but if you can build one at half price, you put a ceiling on it. If you can create a new company at half price, I am a great fan of venture capital for this reason. And we are in the business of creating new values from ground zero. We are not in the business of trading overpriced assets that have been bid up because people are desperate. And that is a huge difference. Another difference, by the way, is that American capitalism in particular has become a little fat and happy, is how I like to describe it. It's too monopolistic. It has too much political influence. It gets the laws of the land changed in its favor, whether they're environmental or tax. And they've simply learned to be less risky. Why start an exciting but risky new enterprise when you can buy your own stock back? And so they do buy their own stock back. And that burden of starting the new enterprises passes down the pipeline to venture capital. And we have never seen more interesting opportunities. Venture capital, not surprisingly, has a higher return than the stock market because of the riskiness of each individual unit. But if you have a diversified portfolio, you have no more risk than the stock market, but you have a higher return. And the green VC part of it, which is springing out of the woodwork, is going to have a very high top line growth rate. Of course, electric cars are going to pound to death the growth rate of gasoline cars. Of course, wind and solar is going to overwhelm gas, electricity, and storage is going to be epic, and energy efficiency. We are going to take tens of trillions of dollars to green our economy, and we must do it. And those opportunities, unlike building walls along the Palisades with FDR and creating handsome-looking parks, the green investments that we should be making have a high societal return. When you insulate a northeastern house, you get a nice cash return saving for 30, 40 years. When you improve the electric grid, that would be a great idea, and China is surging ahead as we speak. You get a handsome return in savings. Instead of losing 15% at 500 miles, you lose 2%, and so on and so forth. And we are letting China get a running start on transmission, on wind, where they dominate, on electricity, where they dominate, and even in electric cars. They have 300,000 electric buses, and the US has 400. What are we thinking about? I've spent my entire life fighting the Fed, frankly. And what I will say is this, that typically the Fed wins many more rounds than we do, than we have. But in the end, we've had a knockout. In the end, the Fed has not been able to keep the tech bubble going indefinitely. It sent it over the 21 times earnings of 1929, and it sent it up to 35, but it couldn't go on indefinitely. Even Japan, that went to 65. The price they paid when you finally knocked it out was, here we are, 31 years later, not even faintly close to the high of 1989. If you go into their real estate market, which was an even bigger bubble, I think the biggest bubble, including the South Sea bubble ever, or tulips, they went down for 30 years. And now they're bottoming out, maybe, but they're bottoming out in central city prices at a quarter of where they came from. And the price you pay for that is you could be 50 years later and still not back to that level again. I would say don't fight the Fed if you're a short-term player. But if you're a long-term player, you have to be prepared to fight the Fed on occasions. I'd like to give you an example of the difference between short term and long term. And that is, I've been a fanatic on climate change for 20 years, but it was only in '07 that I first wrote a paper urging people to take it seriously. And what has happened since then? We could never say that the next quarter or the next year was going to be troublesome for oil stocks, which is, if you will, the anti-climate portfolio. But when the smoke cleared, oil as a percentage of the